Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.
In this lesson, we'll examine stocks and bonds as they relate to calculating basis. Stocks and bonds are considered investment property, and a taxpayer must know the property's basis in order to determine loss or gain on the sale or other disposition of the property. Generally, a taxpayer's basis in investment property is the actual cost of the property, which means the purchase price plus any cost of purchase such as commissions, recording fees, and other such expenses. When a taxpayer acquires stocks and bonds by a method other than purchasing them directly, the basis must be determined by something other than cost. Usually, in such cases, the taxpayer will need to know either the fair market value of the property or the adjusted basis of the property's previous owner. When a taxpayer acquires stocks and bonds that he or she did not buy, the method by which the property was received often determines the rules by which the basis of the property is figured. If a taxpayer receives stocks or bonds in exchange for services, then the taxpayer must include the property's fair market value in his or her income for the year, and that same amount becomes the taxpayer's basis in the property. If the taxpayer receives stocks and bonds at less than fair market value as payment for services, then the taxpayer must include the difference in his or her income, and the basis in the property is the price paid plus the amount included in income. If a taxpayer receives stocks and bonds as part of a taxable trade, then the basis of the new property is its fair market value at the time of the trade. If a taxpayer receives stocks and bonds as part of a non-taxable trade, then gain or loss is not figured until after the taxpayer disposes of the new property. If a taxpayer receives stocks or bonds from a spouse, even as part of a divorce, then the basis of the property is the spouse's adjusted basis just before the transfer. If stocks and bonds are received as a gift, then the taxpayer must know the previous owner's adjusted basis in the property just before the transfer. Special rules also exist regarding the fair market value of the property as related to the former owner's adjusted basis at the time of the gift. When investment property is received as an inheritance, special rules exist regarding the year of the decedent's death as related to valuation of the property. The basis of stocks and bonds must be adjusted following certain events. For example, if a taxpayer receives more stock from a non-taxable stock dividend or stock split, then the taxpayer must reduce his or her basis of his or her original stock. Basis must also be reduced in any case where a taxpayer receives non-dividend distributions from investment property. When a taxpayer sells stocks or bonds and can adequately identify the shares that were sold, then the basis of the shares is the cost or other basis of those particular shares. If securities are sold at various times or in various quantities, it is often not possible to adequately identify the specific shares sold. When this is the case, a taxpayer's basis of the securities sold is equal to the basis of the securities that the taxpayer acquired first. Special rules exist for the disposition of mutual fund shares. Please see IRS Publication 550, Investment Income and Expenses, for more information about adjusting the basis of stocks, bonds, and other investment property.
Like what you see? Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.